Hey everyone, it's Imran from Options Insight, back with your macro options spotlight. Remember, like, subscribe, comment, ask questions, do whatever you like, but we want to get the algorithm passing this around so people can learn about options and learn this information. Okay, market ripping higher at the end of last week on what looked like a bit of a Goldilocks jobs report, showing lower wage growth but more employment. So that's kind of the best case scenario. Now, the bigger reaction really came from the huge ISM services miss that drove more pivot speculation from the Fed and took stocks higher. And that really helped stocks kind of break out and get above that 3,900 area that they are now. Europe and China continue to lead as Chinese officials confirmed that they're committed to supporting growth. And this whole China reopening plus stimulus looks to be really taking hold, and Europe being a major beneficiary of that because they export a lot to China. Commodities have also started to factor this in, especially metals. Obviously, we know precious metals has got off to a great start, but even industrial metals are starting to roar now. Copper attacking that $4 level this morning on the back of what China is saying and really having a go there. And metals and mining sector as well doing pretty well on the back of it and trying to break higher. Obviously, energy has been somewhat lagging. Natural gas prices crumbling in Europe, in the US, on the back of warmer weather, lower demand, etc. And even oil prices having a tough week last week, down 7.5%, although they are recovering a couple of percent today. And we still think structurally that story's in an okay place for oil, but it just might need to chop through some turbulence in the near term. Okay, in terms of FX, if we have a quick look at what's going on there, dollar getting whacked, weaker ISM obviously taking terminal Fed's funds rates lower. Now, the Chinese yuan is really standing out with a 1.5 sigma move there as the stronger currency, as policymakers are getting more aggressive. Bonds did close the week quite a bit higher. So we see a 5.6% move in TLT, which is a 2 sigma move, which is pretty impressive. Back to 105 on TLT there, as the weaker data really saying that the recession may be coming quicker than we thought. And then finally in sectors, all sectors getting an uplift on Friday. ARC kind of finishing the week flat, but really the performance coming out of financials, which are setting up for earnings this week. Maybe a bit of front running there. And metals and mining up 6% on the week as well, as we said, breaking higher. Vol-wise, really the standout is going to be Europe. So you can see on the week, we did have European vols down about 1.5 vol across the major European indices. And they're really starting to screen quite cheap. If you look at the carry side of things, you got a decent amount of negative carry there in Euro stocks. Obviously, China moving around a lot with those big swings. But really, Europe starting to offer what looks like quite good value on the vol side. Okay, moving on. If we say what's been going on last week, really the thing that I noticed was Goldman were pointing out that retail selling was huge last week, right? So across the space, you know, they have various ways of measuring retail flows. They're saying this is the largest week in terms of retail selling that they've got in their entire data set, and which goes back quite far, right? Now, that would explain why Apple and Tesla were having a tough time last week, especially Tesla. Apple did start to recover. And then since then, markets, you know, reacted poorly to the ISM services print. The markets reacted well to the poor ISM services print, which moved rates expectations and reversed all of the prior movers. So stocks were a bit weak. Yields were grinding a bit higher in the front end, expecting, you know, the labor data to come out tight, but that all got reversed on Friday. So the bad news is good news dynamic is still in place. And until the market is told otherwise by the likes of Jay Powell in maybe the February or the March meetings, you know, they're going to continue to price in a higher probability of a pivot when they price in a higher probability of a recession, right? So at the moment, a recession doesn't seem to be a bad thing in the way stocks are trading. There may be a rude awakening at some point later down the line when bad data is not met with a Fed pivot and the Fed just say, yep, we told you a recession's coming, and what? And if they do that, markets will have a sudden repricing lower, but it's not likely to happen in the next FOMC meeting because they're probably just going to deliver the 25 basis point hike that is expected. Okay, it's now priced at around 70%. And then lastly, CPI Data is out on Thursday, so people will be watching that for more clues on rates. But we don't think that's necessarily going to move the dial that much. Surprise, surprise, this week. It does normally create a bit of volatility, but we suspect this one might be a bit less than previous CPIs have done. Now, another factor that could drive stocks higher, apart from earnings, which kick off this week, obviously with the banks, is the CTA complex. There seems to be some asymmetry again forming in that complex, right? Where 1 to 2 sigma moves in the market will then force these guys to then chase and buy large amounts of stock. So systematic funds may be forced buyers of billions of dollars if markets go higher. Okay, and that's something that played a big role to the August bear market rally that we saw. And so it's something we need to be careful of when that dynamic is in the market. We've also got the more aggressive China in terms of, what they're doing with regards to wanting to spur more growth. They've confirmed stimulus efforts this morning. Weaker data obviously is being met with pivot optimism. Earnings that may show cost reductions as we've got all these layoffs coming from the banks and from the tech stocks and stuff like that. We've got cost reductions whilst consumer demand might actually hold up for another quarter. And so that may well spark a pain trade higher because we do believe investors probably are quite underweight, expecting an imminent recession. And therefore, there may be a squeeze that needs to happen, similar to some of the squeezes we saw last year. And I think right tail hedges may well be needed once again if you are positioned underweight. And I'm positioned a little bit underweight. So that's why I'm kind of thinking that way. Okay. Now, Europe. We mentioned Europe. So investors are really starting to chase Europe. So we've been flagging like Europe's been outperforming due to China, etc. The warmer weather, meaning the energy crisis didn't really happen. So you can see here European gas prices from 1 month ago. The whole curve has just repriced down by pretty much 50%, right? It's dropped by 50% across the shorter end. So that's this year's prices. And then even the following year, 2024, prices have gone down from like 95 down to 70. So this dramatic drop in gas prices has been met with optimism around the European economy. And, it wasn't as bad as we thought. So they're going to get away with hiking rates because their economy is not going to be quite as weak as we thought. And you're seeing outperformance, right? Obviously, China's up 11% since mid-December. Europe's up something like 5 to 6. And then US indices have been lagging behind with the NASDAQ down, Russell and S&P not really changed. So now we're not really looking to chase the charts here, right, at local highs, because we do think they look a bit overbought in the near term. But what doesn't look overbought is implied volatility in Europe. Similar to the FTSE that we mentioned last week, Eurostoxx DAX vols look good value. So bearish investors obviously go ahead and buy puts. They haven't looked this cheap in a long time. But we actually do think from a vol perspective, for more neutral views on the market, buying 1 to 3 month upside calls, delta hedging them looks like a reasonable way to get exposure to swings in either direction for Europe, right? Alternatively, you could just buy at the money straddles, like we said on the FTSE last week. You'd have a similar profile, and we'd be looking at February and March expiries, so you get to capture the ECB meeting that comes in early February. This is our kind of monitor for equities. Like we said, this carry here does look decent. If you look at how the carry has worked, and this rolling carry diagram kind of shows us where the carry has been across all these indices for the last 2 weeks, right? So you had this big negative carry here, Eurostoxx and DAX, that kind of started to materialize 2 weeks ago. And then you've got China here in negative, you've got Eurostoxx here in negative still, and then the US indices, which are in green, orange here, they're still providing us some more positive carry, right? So this graph that comes out in our weekly every week shows you how the carry has evolved over the last 2 weeks. So which of the indices that have been carrying negatively or positively, is that trend changing or not? So right now you can see this green bar that's persisted for quite some time, and that's showing China has been moving, has been negative carry for well over a week now, basically. In terms of the strategy compass, we mentioned FTSE was out here. It's now getting joined by the likes of DAX and Eurostoxx. So that's what we're saying. It's screening as a buy put because spot looks overbought and vol looks cheap. We're more convinced about vol being cheap than we are about spot being overbought, because we do think some of these charts look like they're breaking out, and we could see Europe re-rating to some extent early this year as what's going on with China. So I wouldn't be necessarily fading the delta of this, but I do think the vol starts to look interesting. And then in terms of trade ideas for today, all right, that's it for today. Thanks a lot for listening. Remember to like, subscribe, comment, ask questions, all that stuff. And I'll catch you here tomorrow. Thanks.